So we're going to look at audit risk and planning. It's one that's been identified time and time again as an area that is poorly answered in the exam and a lot of students find quite difficult to understand. So let's try and break it down for you. Audit risk is a component of the planning process, but it's an important one. As you can see, the planning process itself is made up of many components, which ensure that the audit team have reviewed the client and the audit ahead with enough detail. They have a responsibility to follow all auditing standards and get their opinion right at the end of the process. For your studies, many of the components are knowledge areas. They can come up for a handful of marks, so you should ensure that you do not just focus on the tricky bit, audit risk, and instead ensure you are happy with the content for the whole of the planning stage. You must know a few points for the purpose of planning. For example, to ensure auditing standards are being followed, risks can be managed appropriately, deadlines can be met. Risks must be identified first, which then helps to build the audit strategy. The overall review of the audit. Auditors must look at the characteristics of the engagement, reporting communications and timing, any significant factors which may affect the audit and determine materiality, and the resources the audit firm has to carry out the audit with. Once they've reviewed all of that, the audit plan can then be formed. This is how the detailed plan of the work to be carried out is based on the audit strategy content. It is important to document everything to have evidence that work was carried out effectively. Audit files are kept for each client and the audit plan must be included in that. Decisions need to be made as to when the audit work is going to be carried out. The larger the client, the more time is needed. So for any client that is not a small company, it's likely that you're going to need to carry out some work before the year end at the interim stage to ensure time is not running out after the year end during the final audit. Awareness of considerations from the audit team due to specific audit standards is also needed. Knowledge of responsibilities for fraud from ISO 240, laws and regulations from ISO 250, and also quality control measures needed at the audit firm itself to manage each audit from ISO 220 are all important facts not to ignore. But audit risk and the questions that appear in the exam on this area are the trickiest element of the planning area to approach. Audit risk requires application skills, but you need to understand the knowledge from the syllabus first to ensure you can cope with an exam question. The definition is simply that audit risk is the risk of the auditor giving an inappropriate opinion. The model says that there are three components. There is inherent risk, which is basically the risk of an inappropriate opinion due to the nature of the business. There is control risk, which is the risk of an inappropriate opinion due to poor controls at the client. And then there's detection risk. The detection risk is the risk of an inappropriate opinion due to the auditor not spotting something significant, which leads to a material misstatement not being detected. We can break this then down into two areas. There is the risk of material misstatement, and then there is detection risk. Inherent and control risks can lead to a material misstatement being present. Detection risk, this is different. This is the auditor not spotting the material misstatement and it being left undetected. Sampling can be the reason for this, so it may be just very simply that auditors do not and cannot test every transaction, and there may be an error in one of the transactions that they haven't reviewed. Non-sampling risks can also be a factor and need to be considered. For example, if it's a new client or it's a tight deadline and we need to get the audit completed quickly, then this may add pressure and human nature may allow something to be missed. So how do auditors manage risk? In order to find risks, they need to ensure they understand the client. How? Well, research and time is needed to understand the entity, its environment, their financial reporting framework, and the system of internal controls. They also need to perform analytical procedures. Ratios calculated on the draft set of financial statements, which will be available at the planning stage, can be done to compare the results to last year. We can compare those results to also any budgets and forecasts and any industry averages, which will paint a picture for anything that looks unusual in the numbers. Both pieces of work will identify the audit risks, things that could mean that misstatements are there. For example, new systems being implemented, any big changes in the numbers, any changes maybe to the economic climate around the client are a few ideas to name. They then need to decide on the response to the risk. So what should the audit team and the audit firm do to ensure that the risk is kept as low as possible? This could be a decision to change the structure of the team, such as an increase in the number of experienced team members. Or there could be specific evidence that they might need. For example, if customers paying the client on time is a concern, then inspection of the aged receivables list and an investigation of any old or slow-moving balances could identify potential balances that need an allowance or might need to be written off. Decisions on the type of evidence and audit procedures are made here at the planning stage to ensure that the audit risk is managed later on. If after reviewing the risks relating to the client's audit, you conclude that inherent and control risk are high, then detection risk must be low to keep the risk of the audit overall manageable. If the industry that they're in is being affected by new competition, for example, and the financial reporting systems they have are old and unreliable, then there is a greater risk of material misstatements, and the audit team is just going to have to find them. So, in this case, with a high-risk client, we would need to spend more time planning, and on the audit itself, we'd need to potentially bring in more experienced audit team members, and also increase sample sizes and procedures being carried out. If, however, we have a nice client in a safe industry with really strong internal control systems, for example, then the audit team can afford for detection risk to be a little bit higher. Why? That's because there is less risk of a material misstatement in the financial statements. The audit can then be completed quicker. They can use less experienced team members, building the experience on the team, which is great news for audit juniors. And also they can then reduce the amount of procedures being carried out and reduce the sample sizes. It's a balancing act, which needs to be right. This is why careful consideration is given now at the start of the audit. So, how is this seen in the Audit and Assurance exam? You'll see it in section B, and you will need your application skills ready. There will be a scenario, and they will ask you to identify and explain audit risks, and then describe the auditor's response to that risk. You can see there are 2 requirements here, so you need to make sure you answer it all and not lose marks unnecessarily. Firstly, identifying and explaining the audit risk. You will review the scenario and find what the examining team has written. To give you a few examples, they could tell you that it's a new client. They might mention that there have been some new investments, maybe some large transactions have happened in the year. They might mention that there are legal issues. There might be court cases that have happened around the year end that might need disclosure. There also could be a hint towards going concern risk as well. But identifying those is going to give you half a mark at best. 1 mark is available for each explained audit risk. So to get full marks for each audit risk, you're then going to need to explain and show the marker why it's an audit risk. You cannot tell the marker the impact this has on the client. It's the impact it will have on the auditor and the financial statements. And you need to be specific. So for example, if it relates to a specific balance, also tell them whether it could be over or understated. Otherwise, you could lose out on that extra half a mark. The second part of the requirement is to describe the auditor's response. This is your opinion using what you've learnt from the audit process in the syllabus. What could the audit team do to reduce or manage the audit risk? Application skills are needed again, as you can see. This could be specific work or actions. So for example, does the team composition need to change, as we've mentioned before? Do we need more experienced team members? Is there any specific evidence that we might need to get, or any sources that we could speak to, such as the legal team or the directors? If you describe this well enough and give specific ideas, then 1 mark per audit risk is yours. So, audit risk wrapped up, reviewing it as part of the planning process.